Diversification is bad for an individual person or company to be diversified into too many different things. Think about it. Berkshire Hathaway is certainly the most diversified company in the Fortune 10, possibly the
Yeah.
Fortune 500. Yet they only have 27, 28 people in their headquarters, and they've got experts on the ground in 107 different companies.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi, everyone. I'm Jason Ballara, and this is the Know Your Why podcast. Today, I'm here with Paul Moore. Paul was actually on episode 134. I'm so happy to have you back again, Paul. Thank you so much for coming back to the show.
It's an honor to be here again, Jason. Thank you.
Yeah, I really appreciate it. I'm excited to catch up. Why don't we just start with, kind of tell people that haven't heard that episode, tell them a little bit about your background. I mean, you're an author, a real estate investor. You've done a lot, and so maybe give us a little bit of a recap, and then we'll kind of talk about where we're at now in the market.
All right. So I sold a staffing firm 26 years ago. It's a quarter century. What's up with that? To to a publicly traded firm. And then I started flipping houses, started flipping waterfront lots, started building houses. And I learned something important. I might have shared this before. It's really important that if you don't know how to tighten your own doorknob, you shouldn't build a whole house. Just something I learned. And but
Valid
at any
advice.
rate, yeah, right. Then I got into marketing copywriting when, during the 2008 to 10 slowdown, but jumped right back into real estate in multifamily and hotel syndications. And that went really well. Wrote a book on multifamily, humbly titled The Perfect Investment. And then within a couple of years, I was on every podcast I could get on saying, time out. It's not the perfect investment. It's actually not at all. If you have to overpay, if you have to over leverage, if you have to get floating rate debt, I didn't really know the implications of how bad that could be until it was. And if you have to potentially, assume that Tucson multifamily was going to keep going up at 18% a year as far as the rents, and that your expenses would be lower somehow. And so those were all things that we thought could bite investors and more. And they did. Obviously, the last year and a half, we've seen that. But we had we had put the brakes on multifamily in 2017. We started investing. We put together 6 different funds over these 6 years. And these funds invest in self-storage, mobile home parks, RV parks, outdoor shopping centers, light industrial, a single family home portfolio, and tax abated multifamily. So that's what we do now. And we are really enjoying that, but like everybody else, having a little bit of a slower time right now with the economy and interest rates where they are.
Yeah. And so you mentioned sort of some of the reasons why multifamily is not the perfect. There's probably no perfect investment in reality. There's ones that are they're good and they can be great at times, and there's market cycles and things like that. With the 7 that you listed off now, what do you see as kind of the strengths? And I know there's maybe strengths that are different amongst those different groups, but what kind of steered you in that direction?
Well, we really felt like operators, we felt like investors, really wanted diversification. I know that I did. And we felt like investors should also, be investing with the very best in class operators. So we had a problem. I'm going to back up a little bit. Warren Buffett said diversification is basically for people who don't know what they're doing, which really irritated me because I'm writing a book on Buffett, about his principles for real estate investors. And I was going to leave that quote out. And I thought, what? I can't believe that. And then the light bulb went off. What he meant is diversification is bad for an individual person or company to be diversified into too many different things. Think about it. Berkshire Hathaway is certainly the most diversified company in the Fortune 10, possibly the Fortune 500. Yet they only have 27, 28 people in their headquarters, and they've got experts on the ground in 107 different companies doing the heavy lifting. And so we realized that's what we wanted to do as well. And we also realized there is no way we could be experts in, what's now 7 different asset classes. In fact, it would be impossible for us to be best in class in 2, especially given my age. And, I'm 59 and now, so for me to become great in multifamily and one other like self-storage would be impossible. Can some of your listeners will they actually see this?
Yeah, it goes on YouTube as well.
Okay. So for those who can see this, I'm going to draw a quick graph, and I can try to describe it as I go. So this is the 80-20 sales and marketing graph from Perry Marshall. 80-20, of course, the Pareto principle. And it says here that if you're the x-axis is operators, and the y-axis could be results. I'll put a $sign there. Well, it's not a bell curve. The 80-20 curve goes more like this. It's called a skew curve, I believe. And the skew curve says that if you invest with the average operator in the average deal, you'll get average results, and that's okay. But in bad times, sometimes those average deals aren't the best place to be. So Perry Marshall says, get into the top 20%, because if the top 20%, the 80-20 rule, the top 20% should get in the top 80% of results, and they could get, a higher margin of safety, which is what we really want. And then, of course, higher results in the end. And so on that skew curve, it's way over to the right, which is skewed up and to the right. But if you can get in the top 20% of the top 20%, and Perry Marshall proves that the 80-20 rule is fractal, your results could be even much better. Well, there's no guarantee we'll get any good results. They could all fail. But we think that if you can get in this very best part of the curve, the operators and the deals will turn out much better. Well, we obviously couldn't do that. There's no way we could be great at 7 asset classes. Even Buffett couldn't do that, I don't think. And so we decided to pull back a level and start a fund that invests in multiple different operators, different geographies, different asset classes, different strategies, and even different places in the capital stack, which we actually thought of much later. And so that's what we do, and that's why we did a fund.
Yeah, it's a great point about sort of being that diversification quote. I think it is sort of misleading because so many people talk about diversification as a good thing, and I think, as you said, like what he really means is diversification as an operator. You can't operate 7, 8. You can't be an expert in operating all of these different places. So, but you can be an expert in locating them. You can be an expert in finding the people that are excellent operators, and that's what, as you alluded to, like that's what Buffett's done with Berkshire Hathaway. That's what you're doing with your fund. That's kind of the idea is to find and connect with people that the people you want to connect with then are the people that have niched down and are experts in that specific asset class. So I think it makes total sense. We talked, would have been at least a year ago last time. Obviously things have changed over the last year plus in the economy. What do you, I think interest rates are the most obvious, at least to people, sort of that listen to headlines and things like that. What do you see as the major challenges that we faced, and maybe how do you see things going here over the next 6 to 18 months?
So with interest rates going up, it's created a gap between the debt and the equity. And here's what I mean. It used to be maybe an operator could get 75% or even higher leverage, and they would be able to raise the other 24-25% in equity, common equity, and that includes GP equity they put in. But now the equity's slowed down a little bit, but more importantly, the loan to cost on the debt has dropped significantly. And so a lender might come in and say, hey, I'm only going to do 55% loan to cost rather than 75%. So that's leaving let's call it a 20% gap in the capital stack. That can be filled. I guess there's other ways it could be filled, but the major ways it could be filled would either be with mezzanine debt or preferred equity. So we started investing in some debt, and it was paying pretty well, 9, 10, 11%. But we realized, hey, we could probably get that same cash flow and actually get some upside as well by investing in preferred equity. And so what we feel like right now with these interest rates where they are, Jason, we're investing in preferred equity. Preferred equity often has I won't call it a guaranteed income stream. I'll call it a contractual income stream from the operator. And sometimes that's 9, 10%. And then an upside of something like 5 to 7% on top of that at the time an asset is either refinanced or sold. And so with a potential of a 14, 15, 16, even 18% total coupon, but much projected lower risk, I'm saying that for my compliance people who are listening, the projected lower risk and the potentially higher return are a combination we really like right now. So that's what we're doing.
Yeah. It's a good spot to be in. As you said, kind of decrease your overall risk, and at least you probably you're increasing over what you're getting on a debt, in the debt position, or potentially increasing what you're getting on the debt position, and maybe equitable or maybe slightly lower than the common equity, but even still, like, your risk is so much further down because you're in that preferred spot in the capital stack. So it makes a lot of sense. I think it's needed, right? So it makes sense as the person who is in that position, but it also makes sense from the people purchasing assets and operating them and needing to fill that gap that you just mentioned.
Yeah.
Do you feel that, so with leverage being down, one of the things that people have always talked about as a risky thing, and why we've had different real estate, specifically 2008, the real estate crash, was everybody was over leveraged. That was one of the things that was talked about a lot. Do you feel that the fact that now you can't get quite as high leverage on assets is actually putting everybody kind of in a safer position on assets that are bought now? Or how do you feel? That's a thing I've thought about it, and I'd be interested to get your opinion.
I would say yes, in the sense that, if it's leveraged at, let's say, 50% rather than 75, the debt service coverage ratio should, there's no guarantee, of course, but you would hope would be stronger. Now, the offsetting factor to that is interest rates are higher right now. Right. But I think it's making people way more wary of getting floating rate debt, bridge debt. And I think the offsetting factor, I'm going to be super vulnerable and honest here, and that is preferred equity kind of puts those common equity investors back in the same place, because if preferred equity comes in, it's ahead of the common equity investors in the capital stack.
Sure.
And so if it's, let's say, 50% debt, 25% preferred equity, and then 25% common, the common are just in the same place because, excuse me, they're behind 75% of debt and preferred equity. So they're kind of back in the same place. So I don't know that they're in a safer position, to tell you the truth. I feel like the pref equity and the debt are both, you would think, in hopefully safer positions than they were back in the day when people were stretching up to 80% LTCs, right?
Yeah. Yeah. And yeah, that totally makes sense. If you're in a deal that is using the preferred equity, then it's probably not that different than, having just a debt alone at 75%.
Right.
But yeah, it was just something I've thought about it. It's like, you're going to have lower returns generally if the leverage is lower. That's typically why people get excited about higher leverage deals.
Right.
You can increase the returns to the investors. So it's always a balance between risk and return, right? You're not likely to get super high returns without a little bit of extra risk, and vice versa. So what I mean, nobody knows what's going to happen exactly with the interest rates, and it's funny to look back, to me, in hindsight, and listen to some of the people that I like. Not that I still respect them, but people that I think really do know, have the pulse on the economy and have ideas of how things were likely to go, and the way that they thought things were going to go back in 2022, mid 2022, and then we were hit with historically high and historically fast interest rate rises.
Right.
What do you think happens from here? I think that there's of course always suggestion. There's always, this is what people think are going to happen at the next Fed meeting and all of that. But it's like, I feel like nobody actually knows. So this is not we won't hold you to it, but I'm just interested, as someone who's, kind of been through it. What do you think is coming?
Well, I mean, I spoke to, and it's not like I usually speak to someone from this company, but I spoke to someone pretty high up at Oak Tree today, Howard Marks' company. And he said that he thought that it looks like it's going to be, inflation is going to be sticky in the 3 to 4% range. And he and I both agree that we're probably near the end, if not at the end of rate increases. The economy's probably a little worse than it looks, and gonna get worse. But the question is, how do you get back down to 1.8 to 2.0, targeted inflation? Not sure how, except for an economy that's much weaker than it is today. And with housing clearly being resilient, especially multifamily being as resilient as it's been, which has been amazing. And there's evidence today from the Wall Street Journal article saying that it's much, much better to rent than buy right now. It seems to me it's going to be pretty hard to knock that down. Other stuff's going to have to fall harder to compensate for housing being so strong and resilient. So I think we're, I mean, obviously, not going to want to try to have a crystal ball here, and neither of us would do that. But it looks to me like there's going to have to be a pretty significant softening in the economy, or maybe something worse, like a war. Hope not, that will result in inflation getting back to normal without more interest rate hikes. If it doesn't, maybe we'll see more hikes. I do believe that Jerome Powell is he is a direct disciple of Paul Volcker, who, 43 years ago raised interest rates as far as he needed to kill inflation. And that obviously was into the 20% range.
Yeah. Yeah, that's frightening to think about, but it's it's just I don't know. I'm not an economist, and it's a fascinating thing to kind of watch, and I suppose in a lot of ways, just I don't understand exactly how it ties all together, but it seems from certain perspectives, these interest rates are so damaging to the economy that it doesn't make sense to me. Like, why do you want to go into a recession? So but again, that's coming from a very ignorant place of not understanding all the inner workings of country economy and things like that. But it's hard to be logical about it, or for me to think logically as to what's coming.
It is, and
Yeah,
right. It's really hard to tell.
Yeah. So with your fund, and you're investing in asset classes sort of outside of multifamily, is that because you feel that those are maybe more recession resistant, or what has led you in that direction?
Yeah, so that guy who wrote that perfect investment, no, I'm just kidding. For some reason, people just flooded. I mean, lots and lots of new people, including myself at one point, flooded into multifamily first, before self-storage and mobile home parks and RV parks and these other asset types. And I don't mean that, I mean, there's tons of people in these other asset types, but the flood of new people into multifamily is just unprecedented. And I think what caused that was partially the Jobs Act, which in 2013 to 2016 was all crystallized and caused just a whole lot of additional people to come in and want to invest in alternatives. Number two, you got social media. You got people, like famous people like Grant Cardone or Michael Blanc or other people out there promoting, hey, you can get rich in multifamily. And I'm not saying bad about those guys. Michael's a friend. He's great. But they were out there. They cast a wide net with social media. They brought, thousands of people to their conferences. And then mentoring grew up. So we got these mentoring programs where people train people to do these multifamily deals. And I mean, specifically in places like Dallas and Houston, there are some huge mentoring clubs for, multifamily syndication, and literally thousands of smart people who have paid tens of thousands of dollars each to join these groups, these mentoring groups, and they're chasing after the same deals. And I was told by a broker in Dallas that some of these deals get bid up 20-30% above asking price by several students in the same club bidding against each other. I call it a club, but I don't know what they would call it. So all this happened, and then we got an unprecedented amount of money being thrown at these deals. We've got the popularity of self-directed IRAs, and this is turning into a long answer. So all this stuff converged, and as it converged, multifamily just sort of went through the roof. At the same time, self-storage started becoming more popular. Mobile home parks much more slowly became popular. RV parks, in my opinion, I can't say this as a fact, but I would say that maybe they're like where self-storage was in the 90s. Of course, I don't know that because I don't know the future, but it seems like RV parks, I mean, I know hardly anyone who would know where to go to invest in RV parks successfully. Yet there are some operators that are doing a great job, but that just hasn't really caught on yet. And so this is why I kind of getting back to your question, we like multifamily in certain situations like tax abated multifamily, but I really like investing in more of these alts that have a higher possibility of having a mom and pop operator. Mom and pop operators don't have the desire, the resources, or the knowledge to significantly upgrade an asset, get it running at its full potential. And so they're leaving intrinsic value, as Buffett says, intrinsic value on the table. By buying one of these assets and paying a fair price, you can upgrade the asset you can significantly increase financials and ultimately the net operating income. And hopefully, if cap rate doesn't go too crazy, you can increase the value of the asset. And so, I mean, like when one of our operators bought a self-storage facility that had homeless people living in it and a bunch of people not paying and virtually no signage and deferred maintenance that went on for 40 years, since the same operator had built it 40 years ago in 1982 or 3, no website, no professional management, rates at 41% of market rates. I mean, there's a lot of upside there, and it'd be hard to find an apartment deal like that, but it was possible to find a self-storage deal like that. And I could tell you about 5 more deals that are similar, but that's why we like investing in some of these quote alts.
Yeah. I mean, I think the point there about the mom and pop ownership is pretty huge, because I think it's true. Like right now, if you want to buy it, it's an interesting like juxtaposition, because if you want to buy large multifamily, which is what is kind of touted as this is what you should buy, large multifamily, because of economies of scale, efficiency, all of that, and I agree with that, but the bottom line is, like, there's probably none of that left anymore that you aren't buying from another syndicator or family, someone who's been operating that at a professional level. And so if you want to buy multifamily from mom and pop, you probably have to go smaller, but then you're going to face some of those challenges on the management side. But with these other asset classes, and I guess self-storage is probably, well, I don't know. I don't know this for sure, but self-storage to me seems like kind of the next one in line, right? Like multifamily exploded, self-storage got popular when some people realized that multifamily, like yourself, was exploding. And so everybody's just kind of looking for that next, I guess, growth asset class, if you will, right, that's they're trying to find. So where does, you mentioned, I want to talk about two of the things you mentioned. One, you said single family home portfolios. So where does that kind of fall into your strategy? Why would you include that with these others?
Yeah, 2 reasons. Number one, these folks are buying, the folks we invested with are buying very low priced workforce housing. A lot of it is Section 8 in places like Baltimore, Pittsburgh, Detroit, where there's a very steady demand. They're getting the economies of scale to manage a lot of them. They're getting, in areas like, I believe, Baltimore, from what I understand, if you trash a Section 8 house, or if you end up getting kicked out of the Section 8 program for non-payment or whatever, it's very, very hard to get back in. And there's a waiting list, I've heard, several years long to get these houses. So these houses don't explode in great economies, and they don't take a huge hit in bad economies. They're just fairly steady. The second reason is we invested in pref equity. So by investing in preferred equity, again, we're lower in the capital stack, and we've got that common equity cushion behind us that is in first loss position. And that is what made us more willing to do that, Jason.
Yeah, no, it makes sense. And what about the tax abatement multifamily? What's your, I guess, maybe it's obvious, but like, what's kind of the strategy there? Why that specifically, and how, maybe define that, I guess, for listeners.
Yeah, so there are high tax states like New Jersey and Texas, for example, that have programs where they know that they desperately need affordable housing near cities. There's obviously a lot of people who live near, let's say, New York City or Dallas or Houston, who need affordable housing, but it's very hard to get, especially Class A or B, apartments now that these are being priced so high. And so what happens is an operator, they will go through significant hoops. They'll jump these significant hoops with the local municipality like Houston or Dallas or San Antonio to build or to more likely acquire multifamily that you might be Class A multifamily, and they'll waive the property tax for the next 99 years on these properties if the new owner, the new operator, will make these into affordable, half of the units into affordable. So by keeping half at market rates and half at an affordable level, which is, based on the average median income in the area, the offsetting, the gain from wiping out property taxes is so much higher than the, excuse me, I should say the proposed gain or the potential gain is so much higher than the potential loss from making some of the units affordable, that it's significantly increasing the debt service coverage ratio, decreasing the LTV, and increasing the appraisal on the asset. I mean, I'm talking about dramatically increasing the appraisal on the asset. And so the operator we invest with has done this almost 90 times. And we're pretty impressed with what they've been able to do.
Yeah, that's a phenomenal strategy. I mean, your taxes are very likely, you're even in the non-high tax states is very likely one of the highest expense line items. So, and in places like Texas is tremendously high property taxes. So it's I can imagine you could very easily be able to bring some of that rental revenue down if you're decreasing an expense to such a high level. So that's fantastic. Smart. I like it. I guess I'm asking you questions for my own my own curiosity as to what sort of things I should be looking at for investing in as well. That's very cool, Paul. Well, let me switch gears. I want to get to ask you the questions, and the same questions I asked you last time. I'm sure some of these answers may be the same, but the first question is always based on the name of the show. I like to ask people, what is your why? I think it's oftentimes there's an evolution to the why. I'm not sure that yours has changed in a year, but kind of what's driving you at this point after all this success?
Yeah, I'll say the same, more or less the same thing as last time, but with more urgency. And that is, if you took the record profits of Apple, General Motors, Nike, and Starbucks, at least through 2021, and added those together and doubled that total number of those record profits, you would be about where human trafficking is reporting, well, not reporting actually, their profits per year, according to the U.S. State Department. And The Sound of Freedom blew the lid on this summer, that movie that just took America by storm. It's not an easy watch. My wife hasn't seen it yet because she's experienced some violence against her and some other people she knows in this arena. So it's very upsetting to her. And it is to me, and it should be to everybody. Did you know, and you may want to edit this out, seriously, but Jim Caviezel, who is the star of Sound of Freedom, has done a lot of research on this. He said I think he said he couldn't sleep for a couple years because of some of the videos he'd seen and horrors he'd read about. But he said that for $77 you can buy a barrel of oil right now. But a barrel of human body parts, and I'm not talking heart, liver, brain, I'm talking about just excess parts, that it sells for $77,000 right now. And this is the eventual end to a lot of human trafficking victims. These body parts are used to make life-enhancing drugs for wealthy people, according to what Caviezel says. And so it's just adding to my intensity to try to raise money to fight human trafficking and rescue its victims. The problem is, who knows what to do? Am I going to go on a commando raid with like the Sound of Freedom dude, down in Central America? Probably not. Am I going to send money off to somebody I don't really know? Makes me nervous. Well, our company, Wellings Capital, has vetted a few operators in the nonprofit space, and we've got one we really like. We're raising money for them again on Giving Tuesday. I can just tell you the group's called AIM, AIM. It's aimfree.org, and we're encouraging people to go check them out.
Fantastic cause, and truly unbelievable, truly unbelievable that's a thing at all, let alone such a enormous I don't even want to call it an industry, but
it is.
Yeah, it's tragedy. Gosh, well, Paul, it's like a little bit hard to like kind of just move past that. That is very upsetting. I'll tell you what, let's just say, when people hear this, Paul, you mentioned some of this, I will get it in the show notes, but where do they reach out to you? They want to get in touch, whether it's about investing or it's about human trafficking cause.
Right. Yeah, they can come to our website, wellingscapital.com. And if they want to get free special reports on several different asset classes, including RV parks, self-storage, mobile home parks, you can go to wellingscapital.com/resources. And I would love to invite people to follow me on Twitter @PaulMooreInvest.
We'll put that stuff in the show notes. Paul, you've been on before. I'm not going to even make you answer all the questions. I think it's more important we leave people really thinking about, where we can make a difference. You've got a obviously very worthy cause, and so let's just end it there. Make sure they check out. You want to say that website again? AIM.
Yeah, it's AIMFREE, aimfree.org. And we're actually doing a Giving Tuesday campaign in affiliation with Wellings Capital. We've been able, in affiliation with Collective Genius, to raise and influence about $485,000 in the last 3 years. So we're doing that on Giving Tuesday as well, and would invite people to be part of, reach out and be part of the match or be part of the giving on Giving Tuesday.
Fantastic. Well, thanks, Paul, for coming back and sharing everything with us that you did. I really appreciate it. I love talking to you. Thank you again for taking the time out.
Thanks, Jason. It was a real honor. Thank you so much.
Folks listening, I know you're going to get a lot out of this episode. Please like, rate, and review, and make sure you connect with Paul in whatever form makes the most sense. Thank you all for listening.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?